Shares of UnitedHealth Group are down around 40% thus far in 2025. The company has been hit with a string of bad news lately, and although it has bounced off from 52-week lows, it's still trading around a 5-year low. What's wrong with the stock today, and has it become too risky of a buy, or could it be one of the better deals out there today? Let's take a closer look. So why is UnitedHealth Group struggling so badly? UnitedHealth has been struggling for a while. In 2024, it was down 4%, and the year before that, it was down just under 1%. The health insurance giant has been dealing with a lot of issues since the pandemic. Staffing issues, people putting off surgeries. Now, as things have returned to normal, utilization rates are rising and there's an increase in surgeries. That's resulted in higher costs. In the past few years, there's been a lot of volatility for what's normally a fairly stable business. Today, there are also concerns about cuts to healthcare spending in the US, so that also has investors worried about what lays ahead for the business. But what's happened to the company has been particularly troubling this year. There are reports that the Department of Justice is investigating its billing practices with respect to Medicare Advantage. There has also been a report that it paid nursing homes so that they would reduce hospital transfers, allowing the company to cut costs. These aren't terribly great things to hear about the business. They haven't been proven, of course, but investors are reacting to these developments anyway. And it also doesn't help that its CEO during all this, Andrew Whitty, recently resigned. And it was just for personal reasons. Maybe the reasons really are personal, maybe they have nothing to do with the business. Or perhaps he got pushed out or doesn't want to deal with all this drama. Who knows? But a change in CEO as all this news is unfolding isn't a great sign. But the good news is the person who's taking over, Stephen Hemsley, was the CEO for the company from 2006 to 2017. So it's someone who's familiar with the business and who can hopefully steer it back into the right direction. Unfortunately, the company has also suspended its guidance for the year, another bad sign that the business doesn't have a solid grasp of what its earnings might look like given rising costs. And investors have punished the stock for that uncertainty. However, the company's long-term growth target is still to grow its earnings between 13% to 16% per year. The good news is that it hasn't abandoned that goal, but whether or not that will become a reality is still a big question mark. For investors, the big question is, should you take a chance on the stock right now? UnitedHealth's business is facing some adversity right now, a lot of it. And when that happens, generally a stock gets punished badly, perhaps too much to the point where you might think the market has overreacted. And when that's the case, it could make for a good contrarian pickup. So right now, the stock is looking really cheap, not only in terms of share price, but also its price to earnings multiple. It's at a multiple of less than 13, which is well below its 5-year average of more than 25. Even if the business slows down a bit, odds are it's not going to crash drastically. Based on analyst estimates, it's trading at 13 times its future profits. That higher multiple tells us that analysts expect worse earnings ahead, but not a whole lot worse to suggest that its bottom line is just going to implode. And the company is also looking at exiting Latin America so that it can cut some costs and focus on the US market. While it's not a huge part of its business, it has been losing billions on its Latin American operations. And by focusing on efficiency and minimizing losses, that can help ensure its bottom line remains fairly strong. So that should be a net positive for the business and investors. Another reason you may want to consider the stock right now is for its dividend. It yields 2.9% right now, which is higher than usual for the stock. A big reason is because of the decline the stock has been on of late, which has been pushing its yield up. The company has increased its dividend by nearly 80% over the past 5 years. And even though its earnings aren't great, the stock's payout ratio is still at around 35%. The dividend doesn't look to be in danger. The company may slow down the pace of dividend hikes in the future, but I wouldn't be surprised if it still continues to raise the payout given how strong its financials are. Overall, I think there's a lot of bad press and concern around the business right now, but that doesn't mean it can't recover. There's simply been a lot of it of late, which has been piling onto the company and burying the stock. But with its old CEO back in place and the company not abandoning its long-term growth target, I'm optimistic that it will be in okay shape despite all the issues it's facing. UnitedHealth plays an important role in the US healthcare system, and with a low valuation and a high dividend, it may be worth buying it right now. It could take a while for it to win back investors, but the stock should be able to generate some good returns if you buy it at its current price. So what do you think about UnitedHealth Group stock? Is it worth buying, or do you think it's headed for even bigger losses down the road? Let me know in the comments. And be sure to like this video and subscribe for more videos like it. Thanks for watching.